Billionaire Barry from Starwood is at it again, declaring that there is a Category 5 hurricane headed for the real estate market. Not to be outdone, Ken McElroy has put out a video talking about Red October starting this quarter. We're going to talk to the one and only Anna Kelly, who she and I had been warning you for a year this was coming. So I want to congratulate Barry and Ken for finally getting on board. But Anna, it seems like the pain is just on the cusp of coming in the commercial real estate market. What are you seeing out there?
Absolutely. The pain has started, but it hasn't become that category 5 yet. Maybe it's like a category 3 that's increasing speed and increasing speed rather quickly and rapidly. And so, the biggest thing, and we've talked about this, before on this show, that should have told everybody in commercial real estate a year and a half ago to get ready and get their ducks in order, is that historically, if you look at investing outside of just the residential space and you look at just typical investing, what all investors, and especially commercial and corporate investors, big REITs, hedge funds, etc., what they do is they say, what is the risk-free rate of return? So that is, basically the Fed rate that we can borrow at risk-free and make a certain return risk-free. And typically that's in a US Treasury bond, a 10-year Treasury bill. And they say, well, if I can make, for example, 2% on a Treasury a year and a half, 2 years ago, if I want to make a better than 2% return, then I'm going to have to find something that moves me up that risk ladder a little bit that'll pay me a better return. And typically you go from US Treasuries to like AAA or municipal bonds, triple B bonds, and then you get into commercial, really high quality, new commercial real estate as the next riskiest thing that provides a better return than your risk-free rate of return. So for example, just to show what's happening and what we kind of foreshadowed because of our experience, right, is that if treasuries were paying 2 and the typical spread on, let's say, an apartment building is 230 basis points, then we would buy a building if we had all cash and we were institutional investors for a 4.3 cap. A 4.3% rate of return if you pay cash, to simplify what a cap rate is. And so when the Fed rate suddenly goes up to 5, well, is anyone going to buy a commercial real estate property at a 4.3 cap and make 4.3% on their money when they're actually taking more risk than just parking their money in a treasury? Absolutely not. They're going to go, wait a second, if I can make 5 in a treasury, and the typical spread for that risk of owning commercial real estate is 230 basis points, then I want to buy that property now at a 7.3 cap, right? So what happens to commercial property when you could have sold it for a 4.3 cap, and now investors that want to buy it from you want a 7.3 cap? The cap rates haven't gone up 3%, but they are starting to rise, and they will continue to rise as long as the Fed keeps status quo or, God forbid, continues to raise rates. So what that means is it doesn't matter. This is the scary part, because I'm a commercial real estate investor. I invest in multifamily, right? So I'm in this every day. But the scary part is it doesn't matter how good you are at raising rents, raising incomes, cutting expenses, because the value of commercial real estate is essentially that net operating income divided by that cap rate, or the going rate of return that the market expects to take on that risk. So you've got to be phenomenal at getting that net operating income up to counteract the downside and the fact that that cap rate on the bottom is going up. And it means your values could come down 30, 40, 50% just because interest rates changed. And that is what is happening. And because all these loans that were taken out in the last several years by us commercial real estate, investors who got used to, 3 to 4% interest rates on commercial property, that drove up the prices. But all of a sudden, our commercial debt is variable. And this is a difference between residential real estate, is we might only get that rate locked at that 3 or 4% for 2 or 3 years, sometimes 5 years, depending on the type of debt you did. But with most commercial real estate, especially office and retail and apartments that were bought over the last several years, those debt payments are now doubling because interest rates went up. So now not only is your value less if you had to sell it, but you are cash flow constrained because your debt payments just doubled, leaving very little cash left for you and your investors. And that's a double whammy that puts a lot of risk, or this category 5, warnings, and this red October from Kenny McElroy. It's really happening, and it's unfortunate.
Yeah, there's going to the losses have just started. There's always that
Yes.
Houston example that blew up $100 million in 11 months. It won't be the last. I've been warning about this for so long, because one of the reasons I go to events is I want to know what the audience is doing. Why do I do that?
Yes.
Frankly, the audience chases the latest fad. And
Yes.
I remember doing a San Jose event in 2020 where seemingly everybody was a brand new syndicator. And I'm like, oh, this is not going
Yes.
to be good. And then over the next 2
Yes.
years, they won, right? Cap rates went from
Yes.
5 to 3.5. They look like geniuses.
Yes.
But now they're going to go from 3.5 back to 5, 5.5, 6, some 7, 8. And even if you're a good operator, some great operators are going to lose buildings. Wrong debt,
Yes.
just
It's
bad
true.
time. Just bad time.
Right. Right.
Lots of
And
the
I know a lot of really good operators that have strain. The other thing that's happening there is that even if we were wise and bought cap rate insurance, which we did, I pretty much always have fixed rate debt, at least for 5 to 10 years on multifamily deals. But if you did like a agency loan with a floating rate and bought cap rate insurance in case rates went up, that is a new product that not a lot of people had ever really seen. And so, we bought cap rate insurance on a property, for example, that went, Michael, from 36,000 a year, nut on our expenses, to almost $1 million a year to renew it.
wow.
And the banks make you renew it. So if you're depending on $36,000 of expense for your insurance and it goes to $1 million, that could bankrupt a lot of inexperienced
Oh,
operators who
yeah.
don't have a lot of reserves really quickly. Now, we had a lot of reserves, so we were able to absorb that in the one property we had that has this variable rate interest issue. But still, without that experience and a lot of cash, really good operators could go under just because of that one thing that they thought was safe, but it wasn't
Yeah.
safe enough. And,
Yeah.
the unfortunate part is that the Fed said, in January, a year ago or two, might be at this point, basically, we're not going to raise rates. Inflation is transitory. We're not going to
I
raise
remember.
rates. And so basically all these investors thought, hey, the Fed has said we're safe. They're not going to raise rates, so we don't have to worry about this too much. And the fact of the matter is, this aggressive monetary policy increasing rates is going to destroy a lot
Yeah.
of big companies. Now, the only kind of good thing about a lot of commercial real estate is a lot of those loans are non-recourse. And so what you're
Sure.
going to see is a lot of operators, and you've seen some big, multi-billion-dollar hedge funds give
Mhm.
back the keys to office buildings in, Seattle and in New York City. And they're like, sorry, we can't do anything. And they're going to get out of it unscathed. The problem is all their investors that invested in that deal, they've lost all their money.
The
They don't get
equity.
it back.
It's
The
the
bank took the
equity.
property.
It's
So
the equity.
that's,
It's
the
gone.
really unfortunate part is that investors lose, even if your operator is and was really good, just based on timing and interest rate changes.
Yeah. What I think is really going to go down is again, I think the pain has just started. It will absolutely be a category 5 red October. There are going to be great operators to lose. There can be a lot of average operators get crushed, and all the newbies that frighten me are going to be wiped out. And it's the LPs that are going to feel it, right? Most
Yes.
kind of GPs don't have huge skin in the game. A lot of them, and again, a lot of folks are raising on social media. Everybody knows who I'm thinking of, at least, several of them. The bigger the name, the lower the return.
True.
They're also
True.
going to lose. So I mean, there's a lot of people going to get hurt because of this. And the folks that got prepared, that raised dry powder, that locked in their multifamily with 30-year debt sub 4%, we're waiting for the opportunity. So Ken tells me it really starts Q4, the acute pain. Having been through this cycle before, it probably means the opportunities are Q2-ish next year, because it takes time to go through this giving back to the bank.
Yes.
Is that kind of fair?
It is. And the other thing that I'll say that I'm watching carefully, and I haven't seen the final outcomes yet trickle down to the bank, but the Fed and the Treasury met about a year ago. I think it was fourth quarter of last year, actually. And they said, we see that the next pain point might be commercial real estate. Okay.
Mhm.
Then after the banks started to fail because of, their hold to maturity bonds that they bought that normally were super safe investments, but
Not
ended up turning
anymore.
around to bite them. The next super safe investment that turned around to bite is commercial real estate because it's lower on that, on that risk
Yeah.
reward continuum than the stock market is, historically. And so, unfortunately, commercial real estate is at risk. But what is definitely known is that the Fed knows that this is a pain point that they've got to do something about. So what they've done is they have now come out to the agencies and to large lenders and said, we want you to put in a backstop to start working with the commercial real estate investors that are struggling. Do what you can to renew those loans on these good assets, keep them going, don't make them refi, don't foreclose on them. So the question is there legislative tools that the Fed is going to use to help out these agencies and the banks to say, we'll insure this mortgage for you, or we will give you a certain amount of money if you will do it, etc. So that's what we're waiting for.
Yeah. So again, bailouts. Said another way. Not a huge fan, obviously. Capitalism, you're supposed to have the good and the bad, right? Papering over this with a bailout, it's not something I would encourage. That said, likely to occur, I suppose. But even in that, it will be a short list of people that are covered. And I think it will probably be office. I think office is going to get probably the most love. But there's again, I'm not shopping for a huge apartment building. I'm looking for the 5s to 40s. Those mom and pop borrowers, they're not going to get bailed out. It's going to be the big operators.
Absolutely. The biggest ones always get bailed out first. I mean, that's just the reality. So, it's scary, but at the same time, it's really important to understand that there's also huge opportunity. And I know Kenny McElroy's looking at that as well.
Oh
So,
yeah.
the name of the game when you can, it's hard to time markets, but when you can is you try to buy low and sell high. And right, that's why so many have made money, so much money in the last couple of years, because real estate values just kept going up. So you and I both made most of our money in low times in the economy. And so rather than be afraid and say multifamily's over, we've got to say multifamily is shifting. The way we finance multifamily or commercial real estate is shifting. Now we've got to look at those bottoms of those prices to say, when is the maximum point of opportunity?
Yeah.
Have that dry powder, have the experiences ready that you can pounce when properties do go on sale to be able to buy them and make money over the next, increasing economic environment period.
Oh, I'm ecstatic, right? You and I have been clear about the warning. People on my channel know that I've been stacking dry powder to get ready for this. My channel knows I've done creative deals in multifamilies direct with banks before. I think 2024 is going to be awesome if you got ready. If you happen to be somebody that got into a deal because so-and-so's big name on social media, a lot of you lost your money. You don't even know it yet, which is unfortunate. So I'm ecstatic for what's coming. That is the silver lining. All these cycles do offer opportunity, and I look forward to this one. It could be a monster opportunity. Anna, where can people find you?
Great. You can find me here every week on your show. You can find me social media, Anna Kelly, REI Mom, and you can find me at my website for coaching and consulting at reimom.com.
Thank you so much.
Thank you.